at best, earnings aren't really growing that much, even though they did on a year-over-year basis grow in Q3 for the first time in 3 quarters after basically an earnings recession that we were in. But I think that the economy is continuing to slow. I think the Q3 GDP print was a head fake.
Hi, and welcome to Wealthion. I'm James Connor. Well, we made it through another week and another month, and what a month it was. And today I'm joined by my good friend, Peter Boockvar. Peter is the Chief Investment Officer of Bleakley Financial Group and also the editor of the Boock Report. And Peter will help us make sense of this past week and also what we can expect in terms of the financial markets next week. Peter, thank you very much for joining us today. Not only was this past week incredible, but the month of November was an incredible one, to say the least. The best November for the S&P in 100 years. It was up an astonishing 9%, up approximately 18% on the year now. And I want to start right here and just get your views on what was driving this market higher in the past month.
It seems to be solely the belief that the Fed is done raising interest rates, and no one wants to miss a Fed is done rally, in addition to the belief that markets always rally at the end of the year, and no one wanted to miss the performance chase that usually takes place with that. So those are the two main factors that are propelling this momentum, and the market is putting aside why the Fed would be cutting interest rates and just rather focusing on the point that they could be cutting interest rates in 2024.
And I know you spend a lot of time looking at quarterly numbers, and I want to get your views on the numbers we saw from Q3 and maybe what you can tell us what the overarching theme was.
So earnings always beat expectations. That's just the name of the game when it comes to earnings season. The bar is set low, and companies around 75 to 80% of the time beat those earnings expectations. So putting that aside, I think overall it was very much a mixed bag in terms of a tell on the economy. Those companies that did well seem to be doing well more on the execution side, the cost side, rather than the revenue line. And those companies that are in retail, it was very mixed and bifurcated between those that cater to the higher end consumer versus those that cater to the lower and middle income consumer. Even with technology, it was very much a mixed bag. We saw very little growth in Apple, for example. Dell Computer, they missed revenue numbers, lowered guidance. So it was sort of all over the place. I think the net real takeaway, though, is that at best, earnings aren't really growing that much, even though they did on a year-over-year basis grow in Q3 for the first time in 3 quarters after basically an earnings recession that we were in. But I think that the economy is continuing to slow. I think the Q3 GDP print was a head fake, and that will also be a drag on earnings for Q4 and also as we go into next year.
And you touched on the retailers, and I want to expand on this a little bit more. When you look at a name like Walmart or Costco or even Dollar Tree, what was the theme?
Well, it's a consumer that's prioritizing how they spend their money. They're focused more on food and beauty, for example. Ulta had a pretty good quarter to the beauty point. They're also seeing consumers that are making 6 figures that are now shopping at their stores, obviously looking for value, and less spending on discretionary stuff like electronics, furniture, jewelry, outside of what is spent for the holiday season. But just a much more discerning, choiceful, a word that I've heard, and discerning customer in terms of how they spend their money right now.
It's going to be very interesting to see what happens in Q4 and when we get those numbers later in January, just in terms of consumer spending.
Yes. Now, what we heard from a lot of these companies, we've actually heard for a few quarters now. This is not an all of a sudden new thing. It's the cumulative impact of inflation. It's the, for at least lower income people, reduction in the benefits that they've gotten, particularly SNAP, the resumption of student loan repayments. I think that the real question with the overall economy is what happens with the higher income consumer, since they spend an outsized proportion of overall consumer spending relative to their sort of the income decile. Right now, there's some mixed pictures with respect to that. We heard Burberry and Richemont talk about slower spend. And as I mentioned, more people making six figures that are shopping at dollar stores and Walmart. So that's a sign that even they are more focused on how they spend their money. And a lot will depend also on the trajectory of the labor market. We're not really seeing much in the terms of a pickup in firings of note, but we are seeing plenty of signs of a slowdown in the pace of hirings, whether that was directly from the BLS or ADP, but also anecdotally with the manufacturing and services surveys that we see, and also the continued rise in continuing claims, which is a sign that people are staying on their benefits longer and likely because of having more difficulty in finding a new job.
And we have one more Fed meeting coming up before the end of the year, December the 12th and the 13th. It's a 2-day meeting. What is your take? What do you think is going to happen?
Well, it's been well telegraphed by the Fed members themselves that they're probably done raising interest rates, and they can now be they can proceed carefully, is what Powell has used in terms of words. So they'll do nothing. Now it is becoming a more interesting dynamic here with the Fed and interest rates, because at the last meeting, going into, we had a very sharp rise in interest rates, particularly long end interest rates, mostly because the short end's tethered to the Fed funds rate. And the Fed basically said the market's tightening for us, so we can sit back and do nothing. Well, now the market's easing for them, and we'll see what kind of pushback we get from Powell. Powell spoke today, and in his prepared testimony tried to push back by saying that they can definitely raise rates again, and it's way too premature to start thinking about easing, and other Fed members have said the same, but the market's easing for them. The 10-year yield is down to 4.25, and the 2-year yield is down to 4.60, which is the lowest we've seen in a while. So what the Fed does in December is going to be more of how Jay Powell expresses his words in terms of how he manages this market reaction and expectations for rate cuts in 2024 rather than any action. Now, that all said, QT, quantitative tightening, continues on and will continue on well into 2024, and that is a further tightening of monetary policy that the stock market seems to have ignored.
Yes, I'm glad you brought that point up, because everything we've seen so far, this move, as you just alluded to, is all based on interest rate expectations. And a lot of the sectors that have been under pressure in the past year, especially interest-sensitive names like REITs and utilities and the financials, have caught a serious bid. Even gold has actually caught a bid here in the last couple of weeks. And we haven't seen a move in gold in the past century. I'm being facetious, but you know what I mean. Do you think the market's getting ahead of itself in just the expectation of rates not going up anymore or being cut maybe in the first half of the year?
Well, it's the market's reacting to what they've been trained to react to over the last 15 years, is to just buy stocks when the Fed is easing, and thinking that the Fed is just the cure-all to everything. So it doesn't matter what the economic data says. It doesn't matter that it's weakening. It only matters that the Fed cuts in response to any weakening, and that will offset the negative of the weakening. That's the thinking of the markets. And while I understand it, and it definitely helps to explain this rally, I think people should just understand that in previous rate cutting cycles, it actually happened in the middle of bear markets. And in fact, the Fed started cutting in September of 2007, just as the bear market was beginning, let alone ending. So I think people just have to be careful with just buying things just because the Fed is done hiking and may cut next year. Because even if they cut 100 basis points, even if they cut 150 basis points next year, you're still talking about a Fed funds rate that's 4 rather than 5.5%. And 4 is much different than 0. And over the last 15 years, up till 2022, we got used to 0. And as I said earlier, they're still shrinking their balance sheet, which is a continuous form of monetary tightening. In addition to even a 4% Fed funds rate is a continued form of tightening, because it's going to negatively affect anybody that has debt coming due, because the debt coming due was priced when the Fed funds rate was at 0.
Interesting points. And I just want to clarify one thing that you said. If they do cut interest rates, You're saying that should not be a positive sign. That should be a sign that things are a lot worse than the market believes they are. Is that correct?
Well, it'll be in response to, yes, inflation's moderating, so they got to figure out what that real rate will be, the Fed funds rate relative to CPI. It's still uncertain. I think it's going to be higher than the market thinks, but the unemployment rate right now is still below 4%, but at 3.9, it's the highest level since January 2022. And I expect it to be going into the fours next year. So the Fed will also be responding to that rise in the unemployment rate. So they'll be cutting for not good economic reasons. And yes, I know how rate cuts get markets excited, but we do have to understand that there's more to the investment puzzle and business than just buying things when the Fed is cutting rates and selling it when the Fed is hiking.
And Peter, I want to pick your brain a little bit about travel because that's also a good indicator of how the strength of the consumer is. And one of the numbers we saw in the past week after Thanksgiving were the numbers coming from the TSA and the number of people passing through security at airports. And it was an all-time record, 2.7 million people passed through security at airports in the U.S. the day before Thanksgiving. That exceeded the record of 2.6, which was made in 2019. And that would imply that the strength of consumers is pretty good because they're out traveling and they're probably renting cars and staying in hotels. And even when you look at some hotel chains, Marriott or Hyatt or Hilton, they're also doing very well. So how do you explain that?
Well, it's really more reflective of how the consumer is spending their money. They're not spending on stuff, on goods, because they spent a lot of money from 2020 to 2021 on goods. So all they're doing is just shifting their spend. If they were spending a lot of money on goods and services, I would say, yeah, the consumer is pretty healthy and benefiting from rising real wages. But they're only spending one thing and not on another, so it's just really shifting around. And but there's no doubt they're prioritizing, particularly younger people, travel and going to concerts and sporting events and going out for dinner. So the consumer still is spending, and just a question of how long that can continue and whether at some point maybe they start shifting back to goods at some point. But real wages over the last 3 years have flatlined. And while inflation is up almost 20%, wages are up by a similar amount. So while many in the aggregate have not lost pace, they've gone nowhere in terms of real wages. And some have fallen because some people's wages aren't up that much. So I think it's just how consumers are just shifting around, the same dollar that's in their pocket and how they want to divvy it up.
Interesting point. So they're not making more money. It's just that they're spending money or prioritizing their money in a different form.
Well, they're making more money in nominal terms, but not in real terms.
So I want to move on now and get your views on real estate, and more specifically commercial real estate. I recently read a report from a company called Castle Systems, and they look after office building security systems. And one of the services that they offer are security cards. So every time you go in and out of a commercial office building, you have to flash your card. And so they keep track of what's happening with these office buildings throughout the U.S. And I believe they're in 2,600 buildings, 138 cities. So they have a good sense of what's going on. In a report that I recently read, they stated, depending on the city, of course, but anywhere from 40 to 60% of the people are going into the office on a given day. And I'm really shocked by that number because here we are. It's been quite some time since the pandemic, but yet a lot of people are still not going back to work. And I guess my question to you is, what does this mean to the commercial real estate industry? So you have two things happening here. You have higher interest rates, higher cost of capital, but then nobody's going into the office. So when these leases come up, there might be a risk of these leases not being renewed. And so you have a lot of office buildings in the US sitting empty.
Well, specifically in the office space, you're right. Obviously, that the challenges that it has, where people aren't really going in Monday, Friday, and even Tuesday, Wednesday, Thursday, as you said. In some cities, it's really only getting to 60%. There are some cities, Sunbelt cities, that it's getting to 70%. So there's less need, yeah, for space. But there are other parts of the commercial real estate market where the fundamentals are better, but you still have balance sheet challenges. So multifamily is a very good business to be in, uh, especially when mortgage rates are 7.5%. But rental growth is slowing, but it's up a lot over the last couple of years. But for those that have debt coming due this year, next year, 2025, that's where the real problem is, regardless of what part of the commercial real estate industry you're in. Because if it's coming due now, your 3% loan is repricing at probably 8 to 9, and you either need to come up with more equity, or you can find a bank that will work with you, or you just hand back the keys to the building. So that's the stress point, generally speaking, for commercial. But yeah, the office has its own structural challenges. Just as over the last 20 years, the mall business had its challenges, and the B and C malls have gone out of business, and retailers have focused on the A malls. It's going to be the same thing with office, where the high quality, newer buildings with a lot of the cool amenities, they're going to attract more tenants than the B and C mall offices that just don't. And it's just going to be a natural attrition that certainly is going to be accelerated too by the offside balance sheets that a lot of people in real estate have. I mean, after all, commercial real estate has benefited from 40 years of falling interest rates, and that continuous drop made all these real estate people a lot of money and making them think that they're geniuses. But now you have a higher cost of capital world, and it definitely separates the men from the boys, and those that have a good balance sheet and equity and those that don't.
2024 might be an interesting year for the real estate market.
For anybody that has debt coming due, for sure. Those that don't have debt coming due, they should be okay. And if anything, those that have a good balance sheet can take advantage of the distress we're going to see with their competitors.
So we can't talk about real estate without talking about the financials. And if we look back in Q1 of 2023, it was all about the regional banking crisis. Here we are in Q4, the last month of the year, and it would appear that everything is okay with U.S. financials. Maybe you can give us an overview of what you think. JP Morgan is doing very well. Wells Fargo is doing okay. What are your thoughts about financials?
Well, their businesses aren't really growing because their loan books aren't growing. Commercial and industrial loans are back to the same level they were in September 2022. Mortgage business is shrinking. The credit card business, yeah, they're extending more loans, but we're seeing rising delinquencies, and the same with autos. So the banking business is still very tough. At the same time, they have a squeeze in their margins as they raise interest paid on savings and CDs, so as to keep customers from going to money market funds. So the business is still tough. Now, there's been some calm because the Fed created this funding program that allowed banks to pledge their treasuries at par, even though they may be valued at 80 cents on the dollar. And also the U.S. government has implicitly guaranteed everyone's deposits. So that then has calmed down any threats of a deposit run. Now, while it's not explicit, the local bank is not going to get is going to get bailed out, their depositors, the uninsured depositors, by the FDIC, because how can they rationalize bailing out the venture capital companies of Silicon Valley Bank, but then not save Joe Schmo at the local bank who had more than $250,000 in the bank. But the banking business is still very challenged right now. Don't be mistaken by the sense of calm here.
And so if we were to look at the financial sector and maybe even the commercial real estate sector, do you see either one of those as a potential threat in 2024? So, I mean, when I say a potential threat, I mean like a black swan event?
No, I think that the bank black swan happened in '08. I think the problem with the banking sector is that it's just getting access to credit is just getting more and more difficult. And I'm less worried about a viability issue with a lot of banks. No, there'll be some, I'm sure, that get troubled here with bad loans, particularly in commercial real estate. But I'm just more worried about just a credit crunch, broadly speaking. And that I think is the biggest concern I have.
Now, you've also written a lot about China and what's happening there with their real estate market. Maybe you can just provide an overview of your thoughts.
Well, there's obvious distress with a lot of the residential real estate developers. That started a few years ago with Evergrande and has certainly spread throughout. I think right now it seems like the Chinese government is really stepping up their attempts to stabilize the situation. They're honing in on the better capitalized developers, the top 50. They seem to be focused on. Their main thing right now is to get unfinished projects done, unfinished projects that people have put deposits down on. That's what they're trying to get done. So they're lending money. They're offering very cheap loans to banks to extend to these 50 companies and others, but mostly these 50 to get to finish these unfinished apartment buildings. Now, there's a lot more money that's going to be needed to do this, but this seems to be a start because once you get that apartment finished, then you can get the flow through of escrow money to the developers, which will then ease some of their cash crunch and hopefully stabilize. Now, the interesting thing about the Chinese real estate market is that the existing home market has actually gotten better there because the average person is nervous about buying a new apartment until it's finished. So they're shifting their attention to buying existing apartments from people that need to sell. So that market's actually been okay. So I do think we probably have seen the worst in the Chinese residential real estate market. The question, though, is what kind of rebound do we see and where do prices sort of settle out at? But just getting some stabilization would certainly be helpful to the Chinese consumer that has a lot of their net worth tied up in residential real estate and also stem the bleeding on the part of these developers.
Peter, I want to get your views on energy now. Of course, this is a very important commodity for the U.S. economy and the global economy. And I recently read a report from Goldman Sachs. They're looking for a range of between $80 to $100 for 2024. And I was surprised to see it so high. And one of the things that would really help this economy is a much lower oil price. What are your thoughts about oil as we go into 2024?
I happen to be in that $80 to $100 camp. I understand that there's worries about the demand side, particularly if the U.S. economy goes into recession. Europe is essentially in a recession. China is obviously slowing itself. So I understand that demand side creating worries about oversupply. But I do think that there is a newfound discipline on the part of many drillers and countries, particularly Saudi Arabia, in trying to keep prices elevated. I do think there is also a possibility that if the Fed starts to cut interest rates in 2024, you'll see a sharp fall in the U.S. dollar, which could then lead to a sharp rise in oil prices, which would then in turn complicate what the Fed is trying to do in cutting interest rates because then it helps to flare up inflation again. So I am in the higher oil price camp. We're long energy stocks, so I'm also sort of talking my book, but we've been long them for the last couple of years, so owning them and me talking about them is nothing new.
And when you say long energy stocks, are you long the producers, big cap producers, mid caps?
So we're long some of the big European ones, Canadian one, and also long some U.S. natural gas companies, as I think natural gas is one of the cheapest commodities out there, and we're pretty bullish on natural gas.
And if you're looking for lower interest rates, which will lead to a lower U.S. dollar, that's also very good for gold. What are your thoughts on gold?
We're very bullish on gold and silver and the miners, and have been for a while. And now that gold is basically at an all-time record high, getting helped by the weaker dollar and also the drop in real rates, I'm expecting much higher prices. And just one thing with interest rates, just because the Fed is going to cut short-term interest rates next year does not mean that long-term interest rates continue to fall. I see a possibility greater than 50% that long rates actually rise when the Fed starts cutting short-term interest rates.
And so you're, with regard to gold, you're very happy with the move that we've seen in the last couple of weeks, I guess.
Yes, I'm happy with higher.
And what's your strategy there? Do you own the physical? Do you own the large producers?
Both. We're long physical gold and silver, via ETFs, and we're long some minor ETFs and also some individual mining companies.
And if you talk about gold, you also have to talk about what they call the new gold or digital gold. Do you have a view on Bitcoin, given the move that we've seen this year? It's up 130%.
So as a bull on gold, I feel like those that are bullish on Bitcoin, we have the same sort of philosophy on central banking and money printing and so on. So in terms of that philosophical similarity, I'm there. But in terms of where the price of Bitcoin goes, I'm completely clueless. I feel much more comfortable with where the price of gold goes because at least as a major central bank reserve, I can at least somewhat value it relative to the size of central bank balance sheets and the huge expansion that we've seen in them over the last 15 years. With Bitcoin, I have no idea how to value it.
Yeah. I think the way I look at it is it's just a total risk on trade, right? Like I can't get over the move. We've seen just in the past month, it's gone from 28,000 to 38,000. And I guess we've seen the same sort of move in a lot of the big cap tech stocks in the NASDAQ, right? It's just risk on in a big way.
Well, you can draw a comparison over the last 15 years between the triple Qs and Bitcoin, and they do have a pretty good relationship. So you're right. That's what it's proven to be. I mean, Bitcoin has only lived most of their life in a QE zero interest rate and negative interest rate world. It's only the last couple of years that that Bitcoin has sort of tasted something other than that, and it didn't trade well. But now that obviously the people are hopeful that there'll be a Bitcoin ETF that is an actual Bitcoin ETF and the Fed cutting interest rates, it's getting back to the world that it's used to. So it just doesn't have the longevity and sort of tests that gold has had. Gold's been around for 5,000 years, so you've been through a lot in 5,000 years. So it'll be interesting to watch Bitcoin. Again, I understand, I philosophically agree with why people are bullish on it, but I also need to remind people that Bitcoin is not the only scarce asset. 1969 baseball cards that Topps made, well, they stopped making them in 1969. So, a 1969 Mickey Mantle doesn't trade like Bitcoin. It may go up in price over time, for sure, but people don't talk about it like they talk about Bitcoin. But they're similar in that it's a finite asset.
Peter, as Chief Investment Officer, you speak to investors on a regular basis. What are their primary concerns?
It's the concerns that we see every day. It's the new higher interest rate regime, where if you need to buy something and borrow to do it, it costs a lot more, whether you're buying a home, a car, or any other big ticket item. They're worried about the geopolitics, even though geopolitics typically has a fleeting impact on the economy and markets, and just general fragility in with respect to the consumer because of a very notable rise in inflation over the last couple of years. So I think but the life is uncertain, but there just seems to be more unknowns now and a higher level of nervousness out there than what I've seen before.
Very interesting points. And Peter, as we wrap up, maybe we discussed what happened in the month of November, and it was a great month. What should investors look forward to in the coming week and maybe in the coming month?
I don't know. I don't know what will happen the next week or month. We obviously have the Fed meeting. We have the payroll number next Friday, which I think is going to be a big deal. I think in terms of year-end market rallies, we probably have seen most of it in November, and that the December will probably be more of a digestion of that. I mean, the sentiment is getting very giddy here in the American Association of Individual Investors. Their read this week had the bears at the lowest level since January 2018, right after Congress passed the corporate tax cut and Trump signed it. So you have now, basically almost a 6-year low in the number of bears. So any contrarian should get worried about that when bulls are spiking and bears are collapsing.
Oh, I love that stat. Thank you for bringing that to our attention. Well, Peter, that was a fascinating discussion, and I want to thank you very much for making time for us today. If someone would like to learn more about you and your various services, where can they go?
Well, on the wealth management side, they can check us out at bleakley.com and reach out. And if they're interested in what I have to write every day, they can check out my Substack page at peterboockvar.substack.com, and they can trial it. And if they like it, they can subscribe.
Once again, Peter, thank you.
Thanks, James.
I hope you enjoyed that conversation with Peter Boockvar. I know I did. If you are considering how to prepare for your financial future, consider having a discussion with a financial advisor that Wealthion has endorsed at wealthion.com. You can fill out a short form there. It will not take much of your time, and it's a free service, and there's no obligation to work with any of these advisors. Don't forget to subscribe to our channel, Wealthion.com, and also hit that notification button to be kept up to date on future events. We have some amazing content coming out in the coming weeks that will help you with your financial future. And you can also watch our new host, Anthony Scaramucci, every Friday here on Wealthion. Once again, thank you for being with us, and I look forward to seeing you again soon.